Hi guys, good evening and welcome to Money Control Market Weekly. I'm Karunya Rao and as always we're here to talk about not just the week gone by but the big trends playing out in the market and what you as retail investors should make of it. Joining me in conversation today is Ajay Srivastava from Dimensions Consulting. Thank you so much Mr. Srivastava for taking time out and joining us today.
Thank you, Karunya. The name is Ajay.
Yeah, that's what I said, Ajay. Okay.
You said Mr.
All right.
Srivastava.
Okay. Sorry, I didn't get the joke. But what are you making of the current momentum, the current strength that we're seeing in the market right now? Are we close to the peak, or is it the start of something bigger, perhaps a bigger bull run phase?
See, two things. One, of course, it's a great feeling to be in this market because at this point of time, you are at the brilliant intersection of greed and fear. Greed is that I don't want to sell anything. Fear is I don't want to buy anything. And I think that dilemma is kind of working, I'm sure, in many people's mind as to what to do. The fact that will the market reach new highs? Of course, the market will reach new highs eventually, just like we will age and become 40, 50, 60 and thereon. So market will, of course, go up because that's the way the nature of the market is. It will go up. The question is, are you feeling lucky enough to spot the share that will give you the return? Because just being in the market, making, let's take this 12-month return, Karunya, is less than 10% of the equity market on the index. Okay. So the question is really for each investor is your portfolio going to perform? Because the index in the best year has not given more than 10%, which is lower than most fixed income products. Will it give more than fixed income next year at the index? Unlikely. Therefore, the question remains, can you choose your portfolio correctly? That is one. Number two is, are you willing to sell, book profits and churn? Because if you don't churn in this market, you are like a snake and ladders game. You can reach 92 and 93 and you can be back to square one. So greed, fear, snake and ladders, all playing on investors' mind. What a lovely time to be.
Well, absolutely. If you put it that way, it sounds very exciting. But something similar happened last year in October 2021 as well, after which the markets kind of began to move sideways. And then, of course, we saw the sharp correction which followed. Will the current uptrend be different? And if so, then how?
See, market will correct. And the reason it has to correct is because we are baking in a lot bigger growth rates than even the best government estimates, IMF estimates are calling about. And the starting point comes, you look at the numbers of the auto which came out in the November numbers which came out yesterday. The growth over October to November is almost zero at this point of time, or mostly about zero, thereabouts. So you can see Maruti, you can see Eicher, you can see Ashok Leyland. So therefore, one is very clearly seeing that expectation of growth in the stock price is incredibly high. The economy, I don't think, can support that kind of consumption because with interest rates high, it's supposed to bring down demand, is not going to happen. So two things can happen. Either we learn to live with higher P expansion, or we say, listen, I need to get out and go into something which is more interesting, gives me more value and so on. And that rotation is very healthy. You saw what happened in IT. People sold out IT corrected. Now IT is rolling back. Same thing happened in metal sector. People sold out, you bought back and you made good amount of money. So I think the name of the game is going to churn because on a holistic basis, and this economy is not growing more than 6% next year. At the best estimate is 6%. And 6% growth rate, you can't expect a 20% index growth.
Right. Okay. But since you said it's a market where you've got to churn to be in the game, what kind of a churn would you expect or would you recommend people do? Because right now everybody is looking for value or for stocks which have underperformed so far, especially from the broader markets, which are now starting to see some traction. So any segments or any baskets that you think look attractive and interesting right now?
See, the beauty of India is, Karunya, nothing underperforms. Everything performs well because everything is in a P of north of 20, 30, 40, and 80s and so on and so forth. So it's very hard to say that there are pockets which are valid. I think the pockets exist because one, there's economic changes taking place, policy changes taking place, and also exist because there's restructuring happening in the company. At the end of the day, Reliance restructured a little bit and you saw the fallout of the Reliance restructuring. We got the benefit of that. We've seen other groups doing the restructuring, and that's what I can say. Grasim did the same thing, and AB Capital is doing the same thing. UPL is doing the same thing, doing a mega restructuring. Eureka Forbes came out of Advent, except bought the stake. So I think there will be tremendous stories coming from restructuring in India at this point of time. You saw PVR Inox merger taking place. So, just on a standalone basis, can these companies give a 25% growth or 20% growth in market cap? Is very difficult for most companies to do it. And we have seen it consistently. Even the best specialty chemical companies corrected rapidly once the big 2021 demand happened. So, bottom line is, I think look for stories which are restructuring, look for pockets which have got consistently good, and they do become, there are periods in market when they get sold off for no reason. They can just get sold off, no reason for at all. And you can go and pick up those stocks. Ideally saw metal sector blown out of the water by
Hmm.
June 21st, has come back again. So I think some sectors you got to be in place always, like metal, I keep saying, you have to be there. It's a high dividend monopoly sector. So keep buying, keep holding. Don't worry the zinc prices have gone down or the copper has gone down or iron ore has gone down. Eventually they'll balance out, give you dividend, give return. So I think one sector which is very clear from my mind is for Indian investors, metal is a must sector. Number two is, we say is the industrial. I think industrial machinery sector is doing well. Exports are doing well. And to that extent, this is one sector which has consistently given us very good returns in the market. The dilemma comes with the biggest problem is the banking index. What do you do with that banking stocks? Because at the end of the day, they should have given you consistent return till HDFC took away value for the shareholders. So I think I would still say private banks would give you long-term value, but they will certainly not beat the index. And that's the dilemma which a retail investor has. I'm holding HDFC Bank for 5 years. I made no money out of it now. So therefore, while they will give you positive return, I don't think they will be able to beat the index or give you a healthy 20% return. So
Hmm.
banking is again a churn issue. There are exuberance times like what happened in the nationalized banks who thought they'll give a 40% return this year. Fantastic, 45%. Can they repeat it? Who knows? But I think that's the risk you'll have to take. The new age stocks, I think some of them are giving you good value at this point of time. They've got good business model, may not make money, but I think valuation is also coming down to some extent. Put in allocation. And the best part of Indian market, so many new companies coming to the market, incredible. In defense sector, we had only two to start the year with. Now today we have four to at least end the year with. So I think these sectors, some of the new IPO companies doing well. You got consumer names, some which are sectors which you must
Hmm.
hold on to. You're going to keep drinking Pepsi, right? Imagine 1 billion people drinking Pepsi. And now I got holding in Varun Beverages, but it's difficult to believe that company will disappear, right?
Yeah. Yeah. I mean, yeah, makes sense. But right now one has to walk the tightrope between growth and value, and especially at close to lifetime highs. Do you think there is still enough valuation comfort and enough risk appetite as far as retail investors and the sentiment is concerned?
Karuna, it depends where you are, in the sense that, we always look from a perspective that are you fully invested? Are you partially invested? And for some, they must be starting the journey today. Now, they can't help it. If they come into the market an index of 18,100, they start the journey today. So they need to do
Hmm.
some investment today. They can't keep waiting for index to go to 17,000. So I think it's a perspective is, where are you with the investment cycle? Where are you with your investment portfolio? Are you sitting on significant profits, losses, inactivity in your portfolio, where you are? But I think one can reasonably believe that consumer stories in India have a long runway. They may see correction, in which case you please keep firepower to average down. Don't worry about it. Average down is not a bad word. You need to buy into those stocks and keep an on to it. And therefore, I would say in India, quality consumer stories are the safest place to be, because if you don't get exemplary returns, you're not going to lose a capital or a shirt or anything like that. So, number of consumer stories, good quality global consumer stories in India, they are a safe place to be after metals. If you ask me, between these two blocks, you can have a good quality portfolio.
Okay, all right. There's one basket of the market, I mean, which I would like you to address, and I know you're not a fan of, is PSU space. And after, waking up from this very, very prolonged slumber, finally they've started to witness a lot of traction. Many of these PSU stocks have grown in very high double digits in the last 3, 4, 5 months. But is everything hunky dory? Is all rosy, or will once again, some kind of sluggishness and some kind of long term misery sort of trickle in when it comes to public sector companies?
See, government ownership of economic assets will lead to long term misery no matter which part of the world you are in. It didn't matter. Any country in the world who's tried it has lost money on it. Indian investors, let me remind you, look at BPCL and HPCL and IOC. They would be crying at the end of the day. You know what happened to their company? They were supposed to be beautiful companies, right? You have retailing companies with the best real estate in the country world, and then suddenly government said, listen, I'm not going to let you increase the price. Therefore, you may be listed, but sorry, take the loss and look at the investor situation. Same happened defense. Now, defense has done wonderfully well. The question is in defense, will the government change the policy one day and says, listen, the pass through 7.5, 12.5% return, I'm not going to give you anymore because I'm giving out of the government budget. Now, where does that leave the investor? So I think these things, you will keep having a problem with the government because they are subject to government policies, and therefore overnight your value may wiped out. So yes, some of them offer good value. Some are metal companies offer good value. Some are defense companies offer good value. But you need to book your profit. You need to take money off the table because when the government changes the stance, and you've seen it happening in PSUs, you've seen it happening in steel, you've seen it happening in sugar, what exactly transpired, and everything was, all the returns were wiped out at the end of the day. So be cognizant that PSU is a game of government policy. If you don't book your profit, maybe at the end of the day, as I said, snake and ladder 93 and you're down and you'll wonder, why did I not do something to the shares? So I'm not saying don't buy it. Some offer a lot of value in it, but key is, are you booking your profits and keeping a hedge against it? Policy decision of the government, which can take a lot of value out of you.
Okay, all right. Because yeah, I mean, many of these names, as you rightly said, are from the defense space, which is now the big, street favorite. But what about overall, if you look at the market's earning trajectory, Q2, of course, was better than expected, something that markets were working with, already working with a low set of expectations, and they managed to be surprised in many cases on the upside. But do you think the second half of the year holds more promise now that input cost pressure has been waning? Demand also is picking up. Of course, rural still is lagging a fair bit, but net demand looks like it is on the uptick.
We are in the best season of the country at the end of the day. The Great Indian Wedding season is on right now. So I think this season should go up pretty well for most consuming counters at this point of time. I'm not too sure about the capex kind of companies where they will have the same boom, but I think certainly for sure I can tell you consumer companies, liquor companies, they'll have a fantastic period. Hotels, excellent period for them. They're booked out fully. If you try to take the New Year booking, and you can tell what kind of money they're asking from you, right? So I think you're right. We are into a cycle of 3 months of very strong consumption upheaval, upside in this economy. Now, whether that goes on to the next year, I doubt very much because sooner or later, the high interest rate will start to kick in. It takes a lag. It will kick in. It's already kicking in. Inflation is kicking in. You heard Maruti wants to increase prices, etc. So therefore, I think you will see a good quarter of this performance. And thereafter, you'll see a slack coming through because 2 bad quarters will be on the way, which is why I said important is keep alive to this situation, book your profits, maybe come back to some of the stocks you want to get in again, but to expect a linear rise in index in an economy which is going to grow at 6% is going to be impossible. So consumer sector, I have no hesitation in saying will do well in the next quarter or two. And there's no doubt on that part. Industrial, question mark, we don't know. Let's see how it goes.
But don't you think that there's a slight improvement in the global backdrop as well? And this week we just saw Fed chair's commentary coming in, and his tone is slightly more accommodative, slightly more dovish, if not completely. Do you think even our own rate hike cycle could taper off in the next couple of months and inflationary pressures easing eventually? And if so, then how soon do you think that could happen?
I think thanks to oil, a lot of pressure is off the RBI at this point of time. And that's, I think, a great thing happening because inflation. But I think that this increase will come whether it's 35 or 50. I could be astrologer or maybe I'll spin a coin and tell you it's 35 or 50. I don't know. Could be any of those two, right? At the end of the day. The key point is not that. The key point is that inflation has eaten into people's earning power. Inflation has eaten into the savings you do because India still and the rest of the world has net negative interest rates at the end of the day. We are not positive interest rate. So whatever saving you do actually becomes lower at the end of the next year and next year and next year. Therefore, we need to keep saving more and more money. And that's what the mutual fund SIP is telling you all about. So I think interest rate will play its own game. But the fact is consumption, if it does not sustain, and you've seen government consumption, you saw the latest numbers, The government consumption expenditure has fallen in this quarter compared to the previous quarter and last year, which is, which is a good sign if you ask me. It's not wasting its money, but money is not coming into the system at the end of the day. So I think interest rate will kind of peak out in the first quarter of next year, definitely. But the impact of that will then start to flow through over the next 2 or 3 quarters, which will tell us lower consumption in the economy at this point of time. It doesn't matter, oil prices have gone down from 100 to 60 or 65 for ourselves. Our prices have not changed because our companies are recovering the past losses. So the benefit
Yeah.
doesn't come through the consumer. And even if it comes through, you'll find that the excise rate will go up and the VAT rate will go up, and therefore I'm not sure whether end consumer will eventually see 30% reduction in his petrol end prices. And that's the problem in
Hmm.
India, that we say price has gone down, but I'm still paying the same money for fuel, and I'm sure so are you.
Yeah, I mean, yeah, I mean, one can't disagree with that. But do you think, I mean, this time around in the last few weeks, we have seen the return of risk appetite, which was reflected in the strong comeback of foreign institutional investors. Up until now, what augured well for Indian markets was the strong support from DIIs. Now that FIs are also coming back, do you think it'll last? Or again, like you said, after a quarter or two, it could again sort of wean off?
See, FIs are coming in, but that's a different set of investors. These are opportunistic investors, these are hedge fund investors who spot opportunities and come into the market. But the overall theme, if you look at the PE theme of the country, is by and large sell out. You've seen how many
Hmm.
people are selling out. You saw the deal in Policy Bazaar, you saw the deal in Nika, you saw the deal in Paytm. By and large, there is more sales happening at the upper end of the PE cycle than money coming into. You don't see large PE deals happening anymore if you noticed it of late. It's all about exits. The insurance company guys have exited. The big institutional investors are exiting. So I think from an Indian scenario, one can very clearly see at these valuation points, the good quality long-term investors are happily booking profits, taking it out of the country. It's the hedge funds, the transient money, which is coming through and which can go out equally as fast. So I will not read too much into the FI holding, because the big picture is telling us that big guys, the institutional investors, the PE investors, are actually taking money off the table.
Hmm. So right now, with so many parallel things happening globally, locally, on the macros front, commodities, inflation, rising interest rate regime, which may or may not taper in the near term, how should retail investors play this whole situation to their own benefit? What's the best way to ride this uptick that we're seeing in the market and to maximize your returns, or benefit your portfolio in the best possible way?
I think my suggestion to everybody would be, first important thing is, if your portfolio has made money, book some profits. Cash in the bank is all the reality, rest is all paper. So one I would really suggest is, please book profit. Number two is, if you need to go to a segment, let's take you want to go to the metal segment or consumer segment. Just broad-based your share with 2 or 3 shares. Don't put 10 shares, don't put 15, but just 2 or 3 shares which you really feel committed to invest in it, and your ability to hold it for a couple of year or 2 years at least at this point of time. So you ride through at least 2 or 3 big consumption cycles at the end of the day. So Indian consumer stories are a good place to be for two reasons. One, they are doing very well. Number two, smaller players are getting bought out by the larger players. So there is a M&A play, there is a performance play. So all consumer stories, whether it is a shoe company, whether it's a garment company, whether it's cosmetic companies, all are reasonably doing well, and they're all bought out candidates. Plus, so therefore, on a consumer space, you are pretty well secure that you got a good, at least consumer demand seems to be okay on that part of it, and you need to do it. Metal, as I said, you need to be in metal, because if India has to grow at any rate, you need the metal. You need aluminum, you need copper, you need oil, you need whatever. And beauty of India, there's only one company in multi-metal and 2 or 3 other metal companies. So you don't have to look beyond 3 or 4 to buy in, and they give you very good dividends. So I would say focus on these two sectors. Banks, I would still say allocate little, but if you want to be in the bigger 2, 3 banks, you want to play the game of nationalized banks, PSU banks, please go ahead, play it. But as I said, it's a brilliant game to trade shares. That's a brilliant game. You need to get in and get out, and you are absolutely fine. Now you look at other sectors, in every industry, Karuna, you'll find 2 or 3 very good names at the end of the day. And least of all, if you get opportunities, that, for instance, when Adani bought the deal for Ambuja Cements,
Hmm.
the Ambuja Cement share was available at less than entry price of Adani Group in the stock market. Less than price.
Hmm.
Now, what better opportunity is that if you have cash in the bank to say, if Mr. Adani buys at 380 and I'm getting a 372, let me go behind him. At least done something better. I'm not saying his analysis, it's the best way to invest, but I still believe that people who create value, you can follow some of it. There's no harm in ashamed in saying, let's follow him. So I'm just saying, he bought at 383, you are getting a 372. What's a rocket science? And today it's about 550 or so. So I think you
Yeah.
need to keep a watch out that wherever big PE funds are going, big transaction happening, if you can get close to entry price, I think you need to look at those opportunities. It ensures you don't need to do R&D, you don't need to do research, you don't do anything. If a big guy is committing $5 billion, believe me, he's going to look after your investment as well.
Okay, there's also one more stock, that keeps popping up a lot on our, in fact, on our live feed as well today, and in the last few days, which is Reliance. Clearly a big winner and a big contributor to the market momentum in the recent weeks. A lot of people have that FOMO of perhaps having missed out on the rally. What is your assessment there of Reliance and people who believe who feel the FOMO right now?
There is no FOMO. Everything is available. Believe me, I've been long enough in this industry to know that you will get the shares when you want the shares at the right price. Okay, you may not get 100 rupees, which was 25 years back. But if you think that 300 rupees is going to make a difference to you, then you're not investing correctly. Because if your idea is that Reliance at 2200, I should have bought, then I can sit out forever. I may still get at 2200. So the key, I think, here is that if you've chosen a stock, let's take like Reliance, like for instance, which I don't have a holding, but I can share it. Okay. Then you have to wait for the restructuring story to play out. You need to wait for that financial services company to come out. You got to wait for Geo to come out. You got to wait for Reliance retail to come out. This is not a story to then buy and then worry about 2 months later. Then you buy this story, then you wait. The first time Reliance did not give a return to investors for 9 years. Karunya, that's less than 3 years back. If you go back to Reliance, for 9 years, the share never gave returns to any investor. And then when it's announced this restructuring, Geo and retail and investors, suddenly 30-40% pop, 50% pop came. So I think people like Reliance kind of companies, you need to wait for the restructuring story to play out. There is no FOMO. You're not missed out anything. Lots more going to happen, believe me. But as I keep saying, keep your firepower. If supposing something dramatic happens to the market and it's available at 2200, then don't say that, oh, let me wait till 1600. Then please don't buy it.
Okay, well, great insights coming in, very candid and very, very doable, very practical insights. Ajay, thank you so much for joining us
You're
once
welcome.
again and sharing your readings of the market with us and our viewers.
Have a great weekend.
You too. Thank you.
Thank you.